Hey everybody, Abdullah here with you. Today we'll be going over part two of the 100x investment strategy, where we'll be going over the key characteristics that you should be looking for in 100 bagger companies, as described in Christopher Mayer's book, 100 Baggers. The focus of our discussion will be on companies that are less than 1 billion in market cap, but above $50 million, because these are the ones that have in the past turned to 100 baggers. Obviously, in the current times, we see companies at 1 trillion valuation, etc. So we could potentially see some of those 100 baggers coming from companies that are above 1 billion, but less than 10 billion. So keep your eyes open in that range as well. But in the past, generally, it's been companies between 50 million and 1 billion. Obviously, there are penny stocks that might go 100x. However, this will be the focus. This was the focus of the book, and this will be the focus of the video as well. But we'll also keep in mind companies that are in the 1 billion to 10 billion range. If you aren't subscribed to my page, make sure to hit that subscribe button right now. Crush the like button so that as many people can see these videos as possible. Leave a comment with your thoughts about the contents of the video, whether you agree or disagree. Additionally, please sign up for my Patreon. The link is below. You'll get insight to my watch list, my portfolio, live updates on stocks to look out for based on my daily readings, and instant posts on my stock buys and sells as they happen every day. So here we go. We're going to be going over these characteristics. So we're going through 7 characteristics. First characteristic of 100 baggers is return on equity, making sure that the company is able to generate profits and cash flow with the equity that you provide to the company. Many companies we see today have accumulated deficits, or they're returning negative amounts on the equity that is provided by shareholders. But you want to look for and filter for and look at stock screeners for companies that have significant return on equity. Their return on equity is increasing, or they have a stable return on equity over many years. This is one of the signs of a potential 100 bagger. The second sign is significant sales growth year over year. Making sure that the company is increasing their sales, they're able to continue to penetrate the market, they're able to gain market share in the relative areas they are. Maybe they're innovating in new areas and able to gain market share there. A great example is Amazon, for example. They continue to have growth in sales year over year over year, doubling their sales or increasing by 30%, 40%, 50%. And this is a sign of a 100 bagger. And obviously in Amazon's case, they were a 100 bagger multiple times, actually. The third sign is having high gross margins, that the company is able to generate their revenue at a high enough margin so that they're able to cover some of the expenses they have and then become profitable. So usually you want to look for companies that have margins of 75% or higher, but anywhere in the 70% range is a great margin to have. The fourth one is an owner operator, somebody who has skin in the game, who wants the company to do well. Examples are like the Jeff Bezos of the world, Bill Gates, Steve Jobs. These all are individuals who had skin in the game. They own the company, they own a huge percentage, and so they want the company to succeed, and they're going to work hard to be able to get the company where it needs to be. Another examples are holding structure companies such as Berkshire Hathaway with Warren Buffett. Again, he's significant amount of equity, and he's going to continue to generate profits and continue to bring cash to the company because he owns a significant portion of the company himself. You want to look for CEOs who are able to manage capital. They know when to buy back shares. They know when to invest in R&D. They know what to do with the capital that they have, and they don't make horrible decisions in their investment strategies when they do generate these cash flows. So you want to look for CEOs that are good at managing capital and looking at their decisions in the past, other companies that they were at, and be able to make sure that they're making appropriate decisions when it comes to managing the capital they have. Sixth is earnings growth. You want to look for companies that are continuing to generate profit. However, you want to pay special attention to R&D expenses. In the case of Amazon, for example, they weren't earning profits for a long time. However, they were spending a lot on R&D, which is taking away from their earnings. And as you can see, because of all those R&D efforts, they were able to get into many different areas, such as they brought Prime, they were able to bring electronic book readers, etc. All of these things were things that Amazon were able to innovate, do their R&D spend. The seventh thing, is moats. Looking for companies that have moats, strong brands. It's very expensive to switch between products in their industry. They might be the cheapest option, like examples are Walmart, where they're just low cost, or in other instances, they might be the biggest. For example, Amazon, they just kept getting bigger and bigger and bigger. So these are the seven different things that you should be looking for in companies: return on equity, significant sales growth year over year, high gross margins, an owner operator who has skin in the game, CEO who knows to manage capital, earnings growth year over year, and a strong moat. Wishing you all the best in finding your potential 100 baggers. I know I'm hoping I have a few in my portfolio. As always, make money, enjoy life. Peace.